Good afternoon, everyone, and thank you for joining me. Today's conversation is about moving from a reactive mindset to a proactive one. Many financial aid offices have spent the last several years responding to one change after another: FAFSA simplification, staffing challenges, enrollment shifts, regulatory updates, and now the implementation of the One Big Beautiful Bill Act, OB3 for short. For many institutions, it can feel like we're constantly putting out fires. Just as one issue is resolved, another appears. Our goal today is not to create more anxiety about what's coming. It's to help you identify where operational pressure points may emerge and discuss practical ways to strengthen processes before those pressure points become compliance problems, student service issues, or audit findings. We'll look at some of the major changes taking effect, discuss where institutions are most likely to experience operational strain, and explore steps you can take now to improve readiness. Think of this session as a chance to move from crisis management to strategic preparation. And hopefully by the end of the webinar today, you'll be sleeping a little better at night, or at least checking your email less frequently after business hours. Before we get started, let me tell you a little bit about myself. I'm Karen Martin Brown. I'm the Senior Director of Professional Services at Portico. Before joining Portico, I served as the CEO and Executive Director of a small college with 2 campuses in Florida, where I wore a lot of hats: compliance, accreditation, financial operations, student services, curriculum development, marketing. Like many of you, I spent a lot of time balancing regulatory requirements with running an institution and serving students. That included navigating COVID, managing audits and accreditation requirements, overseeing financial operations, and helping the institution grow while maintaining compliance. Today, I lead a team supporting institutions through Portico's Managed Services Division, and I spend a lot of my time helping schools work through operational challenges, regulatory changes, and the realities of implementation. That's one of the reasons I'm excited about today's conversation. These upcoming changes aren't just about understanding new rules. They're about figuring out how those rules impact people, processes, and especially students. So thank you for joining me today. Let's talk about what institutions can do now to be ready before these changes start creating operational headaches later. Before we get into the legislation, let's start with what may already be keeping you up at night. This list probably looks familiar: program reviews, audit findings, staff turnover, misinterpreting regulations, manual reporting, last-minute compliance requests, and that general fear of missing something. And honestly, if you check more than one of these, you are not alone. If you checked all of them, well, congratulations, you may be officially working in financial aid. The point of this slide is to acknowledge the reality that financial aid offices are carrying a lot right now. Many teams are trying to manage complex compliance requirements with limited staff, changing guidance, aging processes, and systems that do not always make the work easier. Keep these pressure points in mind. The goal is to identify where risk tends to build and where small operational improvements can make a big difference before things become urgent. Let's start with a high-level view of what OB3 changes from the financial aid perspective. While there are a lot of individual provisions, most of the operational impact falls into a few key areas. First, we're seeing changes that affect how Pell grants interact with institutional and other non-federal aid. Schools will need to pay closer attention to packaging strategies and how aid is layered. Second, borrowing is becoming more limited. Parent Plus loans are now capped. Graduate borrowing is subject to new limits. and Grad PLUS loans are no longer available for new borrowers. Enrollment intensity become a factor in loan eligibility, meaning students attending less than full time may have reduced borrowing capacity. On the repayment side, options available to borrowers are being streamlined, creating a simpler but more restrictive repayment framework for future borrowers. Workforce Pell expands access to aid for certain short-term workforce programs, creating new opportunities for institutions and students alike. There is an increased focus on accountability and student outcomes, with measures tied to post-graduation earnings and program performance. The common thread across all of these changes is that federal aid is becoming more structured, more limited, and more closely tied to outcomes. That means institutions will need strong processes, clear communication, and careful monitoring to successfully navigate this new environment. Beginning July 1st, 2026, students may lose Pell eligibility if their non-federal grant aid equals or exceeds cost of attendance. That alters traditional packaging flexibility and requires institutions to reassess how institutional aid is layered. If non-federal grant and scholarship aid remains below cost of attendance, the student may remain Pell eligible. Second, enrollment intensity now directly affects annual loan eligibility. Students enrolled less than full-time will see prorated loan limits. Loan access becomes enrollment sensitive. Graduate borrowing shifts significantly with the elimination of Grad PLUS for new borrowers. Federal lending is no longer an uncapped mechanism up to the cost of attendance. Defined caps now serve as real ceilings for graduate and professional students. Parent Plus is similarly capped at $20,000 per academic year and $65,000 aggregate per dependent student. Federal loans can no longer be assumed to bridge the entire funding gap. On repayment, OB3 streamlines available options and standardizes elements of income-driven repayment, narrowing flexibility while increasing predictability. For most new borrowers, repayment options are streamlined beginning July 1st, 2026. Workforce Pell expands eligibility to certain short-term, workforce-aligned programs, introducing both opportunity and oversight. Implementation of Workforce Pell continues to depend on federal requirements, accreditation, and applicable state approval processes. Finally, accountability shifts towards post-graduation earnings benchmarks. Programs must demonstrate that outcomes justify borrowing levels. Taken together, OB3 transitions federal aid from an access expansion model to a capped outcome accountable framework. OB3 can change who can get Pell and federal loans, how much students and parents can borrow, how loans are repaid, and when programs can lose federal loan eligibility. An important operational pivot is the legacy or grandfathering rule. It's what determines whether old rules or new rules apply to an individual borrower. Let's take a look at the chart. Reading from left to right, the second and third columns, you can see they start with before. That disbursement before 7/1/2026 proves the loan existed before the law changed. A qualifying direct loan first disbursed on or before June 30th, 2026 is required for grandfather treatment, subject to the statutory conditions, but the law protects students in progress, not students who paused or changed programs. That's why it will be critical to review your defined enrollment period history. It proves the student didn't interrupt or change the program that loan covered. Institutions should establish processes to monitor enrollment continuity and grandfathering eligibility. Grandfathering or legacy depends on two things. One, if a direct loan was first disbursed on or before June 30, 2026, And number 2, the student remains enrolled in the same program at the same institution, of course, with any approved leave of absences. If both are true, the borrower can keep the older limits for the lesser of 3 academic years or the remaining time to credential. If either fails, for example, a transfer, withdrawal, or unapproved leave of absence, or degree type change, then legacy protection ends. The bottom line, one disbursement plus continuous enrollment equals temporary protection. Everything else flows from verifying those 2 facts. Parent Plus is pretty much triggered the same way and will be discussed momentarily. Most changes take effect July 1st, 2026. At first glance, this slide may not seem particularly dramatic because undergraduate student loan limits themselves aren't changing. But that's why this can catch institutions off guard. Many schools will look at the unchanged undergraduate limits and assume there's little impact on their traditional undergraduate population. Beginning with the 2026-27 award year, Parent Plus borrowing becomes a subject to both an annual cap of $20,000 and an aggregate cap of $65,000 per dependent student. For some families, especially those attending higher cost institutions, those limits may be reached much sooner than expected. Historically, Parent Plus often served as a safety net when grants, scholarships, and student loans didn't fully cover educational costs. Now that safety net has a ceiling. As a result, financial aid offices may see more questions about payment plans, alternative financing options, and funding gaps. Students who were previously able to rely on federal borrowing may need additional counseling to understand their options. The takeaway is simple. While undergraduate loan limits remain the same, the overall financing strategy for many families is changing significantly. This is where many institutions will begin to feel the operational impact of OB3. Historically, when there was a gap between the student's aid package and their cost of attendance, there were federal options available to help close that gap. Parent Plus loans could bridge much of the difference, and schools built packaging models around that assumption. That assumption no longer holds. Beginning July 1st, 2026, Parent Plus loans limited to $20,000 annually, $65,000 aggregate per dependent student. For many families, federal borrowing may no longer be enough to cover the full cost of attendance. Pell eligibility can be affected when non-federal grants and scholarships equal or exceed a student's cost of attendance, creating a new packaging consideration for institutions. Add the new enrollment intensity reductions for federal loans, and students attending less than full-time may have access to even less borrowing than expected. Schools can no longer assume federal aid will automatically fill the gap. Financial aid offices will need to think more strategically about packaging, counseling, and helping students understand their remaining balance early in the process. The question becomes, if federal aid doesn't fully close the gap, what is the institution's plan for helping students navigate the difference? Let's turn to some pressure points that commonly break and the assessments that prevent that from happening. Ensure that you know when the student's grandfather period ends. Can you just imagine having to calculate the grandfather end date for all the students in your population? Crazy, right? Institutions should develop methods to track grandfathering eligibility and expiration points. Don't focus on the award year. Award year thinking will cause mistakes. Instead, think student timeline. Borrowing is tied to the student's original borrowing time, not the award year level. For example, a student starts April of 2026. The loan originated in 26-27, was paid April 15th. This student is grandfathered. Let's confirm continuous enrollment. Withdrawals and enrollment interruptions may affect grandfathered status and should be reviewed under applicable federal guideline and institutional policy. Systems should automatically track this, right? So what does a school define internally? What counts as a continuous enrollment? Is it 12 credits? Or maybe 9 credits for graduate and professional students? How about leave of absences and how they impact grandfathering status? What do your institutional policies say regarding leave of absences and point of withdrawal? You most definitely want to review and update institutional policies and procedures applicable to support the changes introduced by OB3. The most important nugget, in my opinion, is cross-functional team communication. You need to agree who owns each assessment. Enrollment intensity used to mostly matter for Pell. Now it directly impacts undergraduate, graduate, and professional loan eligibility. The real issue schools will face is enrollment changes constantly. Students add, they drop, they swap sections. You cannot manually chase every movement. So before OB3, loans and standard term programs were typically packaged at the annual limit. Enrollment intensity didn't proportionally reduce loans the way Pell did. Now, if a student is enrolled less than full-time, their annual loan limit must be prorated proportionally. This is called Schedule of Reductions. This applies beginning the 2026-27 loans. Do you know how to calculate this? After looking at all pressure points and operational challenges, the question becomes, what are successful institutions doing differently? The common theme is that they're reducing dependency on any one person, process, or spreadsheet. They're cross-training staff so critical knowledge doesn't walk out the door when someone takes a vacation, changes roles, or leaves the institution. They're also centralizing expertise by creating clear procedures and documentation that everyone can access and follow. Many schools are looking for opportunities to automate routine and repeatable tasks because they want their staff spending less time on manual processes and more time helping students navigate increasingly complex funding decisions. They're also creating operational redundancy, making sure there's a backup plan when something unexpected happens, whether that's staff turnover, a system issue, or a compliance request. The institutions that tend to weather regulatory change the best aren't necessarily the ones with the biggest teams. They're the ones that build consistent processes, share knowledge across departments, and create systems less dependent on individual people. That's what operational readiness is all about, building a structure that can adapt and continue functioning even when the environment changes. While much of OB3 becomes effective July 1st, 2026, there are several steps institutions can take now. First, define your July 1st identification strategy. Schools need a clear process for determining which students are subject to the new rules, how crossover periods will be handled, and how those decisions will be documented. Next, review your awarding assumptions. Many current packaging models assume access to full loan limits, Grad PLUS availability, or Parent PLUS as a gap filling option. Those assumptions need to be recalibrated to reflect the new borrowing environment. Until systems are fully updated, consider implementing a manual loan proration checkpoint. Even a temporary review process can help ensure enrollment intensity is being applied correctly and prevent overawards during the transition. Schools should also develop clear counseling scripts. Student and families will have questions about loan caps, reduced borrowing eligibility, and potential funding gaps. Consistent messaging will help reduce confusion and escalation. Finally, monitor aggregate borrowing limits. document interpretation decisions, and coordinate closely with admissions and the business office. These changes extend beyond financial aid and require cross-functional thinking. The key takeaway is that readiness doesn't require waiting for perfect guidance. There are meaningful steps institutions can take today to prepare for what's ahead. As we wrap up today, remember that while we may not have every answer yet, we can start preparing now. The institutions that will be most successful are the ones that identify potential risks early, document their decisions, and build processes that can adapt as additional guidance and new regulation are released. We've created the OB3 Readiness Checklist and Resource Hub. Scan the QR code to access those resources and stay informed as implementation continues. Thank you for spending part of your day with me. I hope today's session has given you a few practical ideas you can take back to your campus and share with your team. Thank you.